Good afternoon and welcome to BizTech Asia's Asian Midday Market Watch. I'm Jeffery Halley and our guest today is Kelvin Wong, Senior Market Analyst at Oanda. Kelvin, good afternoon.
Hey, good afternoon to you, Jeff.
Before we get into Kelvin's talking points today, let's just have a look around Asia at the markets. What's standing out here is the rally in China, and we'll talk about the reasons behind that shortly. But starting with the Nikkei 225 in Japan is down to 0.2%. Shanghai is up just over 1%, while the Hang Seng is rising nearly 3% today. S&P ASX 200 down to 0.2%. South Korea's Kospi is down around 0.2%. STI is down 0.15%, with Kuala Lumpur almost unchanged. Kelvin, what do you make of those price actions today?
So what we could see is a very clear outperformance of the China and the Hong Kong stock market. So that is actually the flip side of what we see about a week or 2 weeks ago, where they're actually the worst performer. So one of the driving, drivers of this short-term strength that we are seeing right now in the China stock market and Hang Seng indices is primarily driven by regulatory, initiative by the Chinese securities regulator, where yesterday at the close of the Asia session, they implemented more forceful measures to indirectly curb short selling of A shares, we've got the mainland A shares. Then right over here in today's session, at the start of the Asia session, they actually came out another new form of initiative to actually encourage share buyback for China's security. So that could be a big plus. Primarily, if you're looking at the last couple of years, we know that the champion of the China stock market is primarily driven by the China big tech stocks, like the likes of Alibaba. But however, the share price is being hammered downwards. But they do have a significant cash hold. One of the reasons of the cash hold is because due to the lack of business investment, also primarily due to the clampdown on their business operation that has taken shape in the last 2 years, starting from Alibaba, with the lights that spreading out to the rest of the border in the China big tech stocks. So given the fact that in a couple of weeks' time, in fact, this week we start to see Alibaba earnings announcement, there could potentially be a guiding post by today's China security regulators, giving them a sign to go ahead to please use your cash hold for national service, in a way, to kind of stem the rot in the China stock market. So that's why we start to see one of the prominent Hang Seng Tech Index, which is the heavyweight of China big tech capitalization stock in it, rallying the most today, up by 5.5%. And also on top of that, we have some news flow coming out right now saying that today the top of the top of the China top policymaker, which is the Chinese President Xi, he's going to chair a discussion primarily focusing on the stock market with the relevant regulators. So that actually points to a signal that the top is getting very, very uneasy about this state of weakness that's being seen on the China stock market. So what we could see over here is that yes, we start to see this short-term counter trend rebound that's been taking shape in the China stock market. But however, to actually see a meaningful major bottoming, formation on these indices, we definitely got to see, on the other hand, much more direct fiscal stimulus policy up from the China policymakers, rather than this kind of what I call plugging the holes policy.
Right. I guess this could be a case, though, of China treating the symptoms and not the underlying cause. What would your thoughts be along those lines?
Yes, precisely. So what they're trying to do is they're trying to put instead of getting instead of putting in drugs to actually remedy this short-term illness. I mean, the better way is to have a transplant, you see, to actually remove this stickiness of deflationary spiral that is taking shape in the Chinese economy right now. Pardon me. and also to actually find ways to how to boost business sentiment and consumer sentiment. So we're talking about the unemployment market, the youth unemployment market is still lackluster. Inflationary are still refusing to actually invest more in capital investment, primarily the fact that because it's being tied to the property market indirectly or directly also. So I believe that the only way to address this is we got to have some kind of form of direct subsidies to boost consumer spending and business spending.
Right. Now, that's not the only news that's been out in Asia today. We saw the Reserve Bank of Australia's latest policy decision. They seem to have remained hawkishly unchanged. Could you give us your thoughts on that rate decision?
Yeah, so what's quite surprising to my view is that they still maintain the I'm pretty aware that the monetary policy statement is still being peppered by hawkish vibes, despite the fact that if you look at their monthly CPI data for December has been decelerating in terms of inflationary growth to around 3.4% annualized. So that's the lowest level since 2021, November 2021. But however, RBA's board, based on their latest monetary policy statement, they're still pretty much cautious about inflation being able to hit their 2% to 3% range. Mentioned that putting a very blunt word, saying that sometime yet before it hits. So they are not confident that, despite the fact that the monthly CPI indicator has started to trend downwards. And they also did mention that services price inflation, yes, they do decline, but it could remain high, and it could be still persistent, a kind of similar global phenomenon that being seen in global services inflation worldwide. So overall, it seems to me that the RBA is still wants to err to the cautious side of the story, pretty much in line with what we see in the last week FOMC as well. So it seems to us that the global central bankers, led by Fed for sure, is that they do not want to get their inflation forecast wrong this time, because previously they actually hike slower when inflation is actually spiking before that. But at that point, so they don't want to be seen falling behind the curve. So that could actually explain this kind of a cautionary stance that's been undertaken by the RBA. But what's interesting over here is that it actually put a bit of strength to the Australian dollar. So we know that the Australian dollar is the weakest among the majors last week, ex-post FOMC and after that surprising strong US job data. But its 5-day rolling performance, means the dollar 5-day rolling performance, again, the Aussie has started to temper off. So previously it hit a peak of 2% gain at the start of this week. And right now it's actually only at about inching downwards. Right now recording only a 1.2% gain here.
Yeah, head and shoulders formations on both Kiwi and Aussie at the moment, and central banks more comfortable being in team tightening than team transitory again.
Yes, precisely. So definitely we're talking about the head and shoulder formation. So one of the reasons why the Australian dollar was being sold off, the Aussie against the dollar being sold off aggressively on last Friday was due to the breakdown of this head and shoulder technical neckline support at 65.20 per dollar. So right now it's actually trying to actually retest this level. So if we start to see a daily close by the end of the US session today, as means daily close above 65.20, that could potentially imply a failure bearish head and shoulder. So that could actually potentially kind of extend this ongoing counter trend rebound that we've seen in the Aussie dollar that's still trading below their 50-day moving average.
Okay. Kelvin, thanks so much for your insights and thoughts today. It's always been a pleasure.
My pleasure.
And we've been speaking to Kelvin Wong, Senior Markets Analyst at Oanda in Singapore, on BizTech's Asian Midday Market Watch. I'm Jeffery Halley. This video and podcast will be on our website, www.biztech.asia, as well as our social media platforms. You can also see it on our syndication partners, TV stations, radio stations, and websites. Thanks very much for tuning in.